we have a powerhouse of knowledge and experience in the panel. Exclude me, but the rest definitely. So the topic is build, scale, and list. I think it's very relevant in today's time on what we need to, what in the alternate space especially. So we have split this into 3 rounds, and we'll keep it very crisp. So round 1 is on building and scaling. So Vishal, I would like to start with you since you are sitting closer to me now. So how do you differentiate build and scale? Is build given even when you, even while scaling? And how does sustained building of product, service, tech have an impact on listing or exits?
Thanks, Vignesh. This is a very, very deep question. So let's talk about what is building and what is scaling. Building is investing in initiatives like investing in technology, investing in talent ahead of time, new products, new geographies. And these initiatives do not show up in a positive fashion on your balance sheet and financial statements at the time. Not only that, some of these initiatives may fail. So as a CEO and shareholders, you'll have to be very supportive of these initiatives because they don't show up in the short term. However, once you've built a business and a culture that helps with these initiatives, scaling becomes easy. So therefore, scaling, Vignesh, is very different from building. And not only that, scaling without building is very dangerous. I know a lot of CEOs who've said that I wish I had invested in those initiatives a few years ago. Why did I conserve capital then? And why was I penny wise, pound foolish, right? Now, sustained building is, it pays you back in multifolds. What does that mean? It means that if you've created a business that believes in sustained building, it will show up in your financial statements during volatile times. So when you have externalities, wars, fuel price hikes, your growth will be slightly better than your peers, your margins will be better than your peers, and this drives a lot of confidence in the markets, which means on a like-to-like basis, the market will give you a higher multiple because the risk perception is actually very low. So all in all, small investments in building initiatives will pay you back in multifold despite setbacks.
Excellent. That's very well put, Vishal. So Samir, coming over to you, reaching out that side. See, Vishal touched on build and scale, right? Let's talk about list, the other aspect that is part of this topic. I know it's mostly horses for the courses, but you are an experienced investor, right? So what would you prefer as an exit route? Is it generally an M&A, or do you look at listing? What do you prefer?
Thanks, Vignesh. No, it's a really good question. And I think from our vantage point at 360 ONE, we sort of see a very wide spectrum from sort of venture capital, venture growth, all the way to pre-IPO. So I think we've been really blessed on the pre-IPO side with the robust activity in the listing market. And I think that's been a very natural path. Not always easy to navigate, but I think very positive recently. But I think to your point, horses for courses, I think certainly in our venture and growth portfolio, we're spending a lot of time on private market exits. We've just had a recent sale to a very large buyout fund. We've had M&A activity in the portfolio as well. So I think, to be honest and realistic, especially on the venture side, I think for many of us as fund managers, plan A may have to be a private market exit, and really sort of thinking through, conceptualizing, and then executing that roadmap. An IPO is not for everyone, and I think as you sort of grow into that life cycle, I think a listing can sort of become a plan A over time.
Lovely. So, Shivani, staying on the topic of exits, right? So, I would like to understand from you, how has since you do a lot of private equity, how has the private equity market evolved over time via exits, and how do you sort of analyze companies with an exit lens? So, when you go in, do you see, okay, is there an exit possible already, or do you go with the flow?
Thanks, Vignesh. I think exit is that four-letter word which has finally become very positive in private equity. So to answer this, I will give you all a bit of a historical view as to what exactly happened, right? So if you look at the 10 years pre-COVID, so let's take 2009 to 19, cumulative exits in the private market for private equity, roughly $80 billion. Out of that, over 60%, over $50 billion came through in the years 17, 18, and 19 cumulatively, right? So in the past, I remember me and my peers used to go to international conferences, talk about private equity in India, and a lot of the folks there would look at us and say, boss, you guys have no clue how to exit. Yeah. We were like that, Abhimanyu in Mahabharat, where you can get into the Chakravyuh, but you have no idea how to get out. But then things started changing from 17, 18, 19, pre-COVID, okay? And then, of course, 21, we all remember 21 for various reasons, some of us more unhappily than others. But I think the most interesting piece of data from 21 is that it was a watershed moment for exits. $36 billion of exits happened in the private market. After that, of course, 22 was around 17 billion, and 23 year to date is roughly around 17 billion. When we look at exitability, okay, we look at every company, we don't rely on listed markets. So our portfolio, we are mid-market investors, very much can have an exit, like Samir was saying, an M&A deal, a strategic exit, a secondary exit. So what is the lens that we come in at? We ensure that when we are investing, we ensure that this company should be of value to somebody at scale, which means that the product market fit should be interesting for somebody at scale. Either they should be adding a channel through this, a product, a brand, a new segment. But whenever so this is a very important part of our analysis, right? We had invested in a lingerie company called 𝒂𝒏𝒏, which became de facto the largest leading offline player in the lingerie segment. And we were completely focused on building a very credible and dominant brand, in the women's lingerie space, which became a very good fit eventually for the men's innerwear company Dixie. So we were bought over by Advent, who then merged it with Dixie. So that's the lens that we look at. But yeah, it's wonderful to see exit coming of age in the private market.
Wonderful. So these people have been from the grassroots of the private equity industry. So if they are saying, and also anyone looking to raise money, that's the kind of data you need to have before you raise money from people like them. So that's one point. So Himanshu, coming to you, right? See, whenever someone makes money, whenever there's an exit, there are two people who are very interested. One is the person's respective spouse, and the other person is a tax authority, right? So the spouse is unavoidable, but talking about tax authorities, from a perspective of private companies that are planning to list, are there any specific structuring that you would like to highlight?
Yeah, so thanks, Vignesh.
Especially from an investor perspective.
Surely. So I think absolutely right. So the interest that is being shown by the tax office on any kind of income that is earned has always been there, and it is increasing now with the amount of data that is available. I think the access to data to all the regulatory authorities is significant. So they can correlate things and ask questions. But yeah, so I think from a structuring perspective, especially for private companies which are going for listing, some typical issues that we have seen is that what happens generally is that as private investors, most of the times transactions happen as some kind of preference shares because you need that security and preference of distribution, and typically invest at a premium. By the time you get to a listing stage, because of the way the market expects the value to be within a certain range, the company needs to go through certain amount of restructuring of its capital, and which is done through different modes. Some of the typical modes is one is issuance of bonus shares, where you issue a significant number of bonus on the existing capital so that the per share value goes down. And what happens is that from investors' perspective, unfortunately, the way the tax rules work in India is that you don't get a cost base for those kind of bonus shares, and therefore the tax on the bonus shares is a short-term gain and a significant, delta on that. So that is one thing which kind of impacts investors a lot. And whenever, especially as foreign investors, when they've invested in compulsorily convertible shares, you don't have too much of choice. But one variant of that is that the kind of convert their shares into larger number of equity shares and try to say that that is converted shares where you get a holding period. So those kind of structures do come in. One other thing which is kind of picking up of late is that many companies which are looking to list are some of the larger ones which actually had holding structures outside India because of the way traditionally some in the last 5-7 years funding had happened. Those companies trying to come back to India and then doing a listing is something which has its own set of complications and tax issues similar to what I just described. Just recently, the government has announced or re-announced that Indian companies will be allowed to list abroad. We still need to see how those guidelines are detailed out and how those listing will happen. Maybe as a two-stage process of listing in IFSC and then listing abroad. So those details are still awaited. But those are the kind of structuring issues that one comes across when a private company is going public. And from an investor perspective, tax becomes kind of a driving factor.
So interesting tidbit here. I don't know if I'm not a tax expert. I understand that a lot of private companies, promoters are buying real estate because there's section 54F which lets you to set off capital. I don't know. So, this is happening. So
Yeah,
it's good for the alternate real estate segment also.
Of course. On the last year, they also brought in a cap on that also to some extent. So, but yeah.
Deadly. So going to round 2, right? So round 2 is all about how India is seen globally and how is the situation domestic as well. So again, Vishal, I'd like to start with you. Why don't you lay some special emphasis on global markets, right? How do you see the alternate space in India? Since you have a lot of exposure globally as well and have a firm footing in India, what are the positives? And also, when you see positives, where do we need to step up?
I would say around 2010, as an asset allocator, you would look at the world, rightly or wrongly, as developed markets and emerging markets. And you would allocate funds. And within emerging markets, you will look at China, India, Brazil, and other countries. And I have to say that China trumped India in all aspects, be it returns, governance, or scale, right? In fact, even in India, if you were given $1 in 2009-ish, 2009-10, and you were asked to invest that dollar in either Asian Paints or HDFC Bank, which are listed entities, versus a private company of scale, and take the risk on the promoter and the governance, invariably your answer would be, let me put the money in HDFC and Asian Paints for a risk-adjusted return, right? Now that has completely changed over the years. So I'm not going to bore you about macroeconomic GDP growth and all of that, but what I will say, there are a few reasons for that. One is exits, which Shivani already alluded to. Second, for me, is that the kind of entrepreneurs coming out of our ecosystem are very different from what we used to see earlier. So earlier, there was this thing about the great Indian promoter. They would make money from you as an investor, as opposed to
for you.
For you, correct. But today, so I've met over 400 entrepreneurs in the last 2 years alone, and I can tell you the way they think is extremely different, and I'm actually very proud of that. They want to make money together. They're very transparent, and this gives us a lot of confidence.
I think that needs a round of applause.
Yeah. So cheers to India, cheers to everyone. Yes. So thirdly, India has proven that unit economics work. I can guarantee you, given the audience, if 3 or 4 years ago, if I would ask you, will Zomato ever make money? Most of you all would have said no. But here we are, today, a business that is a platform business with seemingly thin margins, it is still profitable. So that again gives us confidence that Indian entrepreneurs and the ecosystem allows you to actually make profits in the long term. And last but not the least, and I never thought, Vignesh, I would say this, is some being the operative word, some regulators have actually stepped up. Wow. So I would have to say a regulator like RBI, right? They have ensured that India's financial ecosystem is well protected from various shocks. Now, obviously, they've had their learning curve, but I have to say that we are one of the more sophisticated financial ecosystem that we have in India, compared especially to some of the other emerging markets, right? I mean, believe it or not, a lot of other markets do not know the concept of NBFCs, which we know. Yeah. Now, having said that, of course, there
a but comes in. But
there are 3 issues. It's tax, and tax. Okay.
Himanshu, spotlight is on you.
Yeah. So it's basically who all are we taxing? the sheer quantity of tax, and last but not the least, the ambiguity. So in the private equity space, I don't know many companies who have not received a GST notice. Everybody is confused. Whatever you do, you have to expect some backlash, some notice. And that really, really needs to change. Yeah? So that's what
Wonderful.
I would say.
Thanks for the, what do I call it? It's more like the sweet given with a lot of this one at the end. Okay, so
If I can add just one perspective on this, that yes, there are a lot of scrutinies going on, a lot of notices going on. But one positive side of it is that a lot of it has happened now on the electronic media. I think everything is digitized. The speed at which the back and forth with the tax office is happening has improved quite a bit. So in many cases, things are, kind of coming back. But of course, I think the amount of scrutiny is significantly higher.
hope for the day when there's equilibrium. Samir, coming to you, just taking off on what Vishal concluded on. Where do you see this alternate segment as such? Because you have a bird's eye view of where these things are going. So where do you see this alternate segment going? And how do you see this VC-PE space, right? I know you run a private equity and a VC. Do you see consolidation coming in, or do you see more people like me coming and trying to push with people like you? So what do you see?
Good question, and that's a few questions there. So first, I just want to build on what both Vishal and Shivani said. I think in the last decade, the quality of the Indian entrepreneur has improved many-fold. So I would completely agree with that. And I think Shivani's point about exits is spot on, right? At the end of the day, India has always had the potential. I think we're seeing that potential now translate into returns and results through liquidity. I think your question, Vignesh, it's very interesting, and I just want to start with 2021, right? Shivani gave a longer historical perspective. Let's just go 2 years ago. So 21, I think probably overly exuberant, and 23 for some people maybe overly bearish. I think you have to, in venture capital and private equity, take a long-term view and look through the cycle. And I think in 23 today, the funding winter that you see a lot of the media talking about, you have to actually just peel it a little deeper to see where the pullback of capital has been. And as we were talking before the panel, I think a lot of it has been hedge fund, international capital, perhaps short-term capital. And the way I see it, Vignesh, is it's a huge opportunity for domestic capital. And I think for this audience, that's very relevant because there was a report in the parliament in 2020 which said that more than 80% of Indian venture capital and private equity is from international sources. And so I think that's the huge opportunity is domestic capital, very early innings. You're seeing product innovation, you're seeing new asset classes in the overall alternate segment. So I think for new fund managers, there is white space, there is an opportunity. And I think actually in this vintage, we are seeing some really attractive deals and investments at reasonable entry valuations. I don't think anything is cheap, but reasonable entry valuations. And I think for at least speaking for ourselves, we are actively deploying capital.
Lovely. Shivani, over to you. Continuing on sort of the sectoral discussion that some of them touched on as well, which sectors do you see significant investments going to? I know this is a dicey question because today you don't know which sector is going to pick up, but from your view, how do you...
Thanks, Vignesh. I'll just add to what Samir said. I'll start by adding to that. We've never been more excited. We think it is the perfect time to be investing in the Indian market. We don't look at things from a sectoral perspective. Because we think within each sector, you can have subsectors with completely different underlying business fundamentals, and we're very fundamentally driven. So we look at things from an investment theme perspective, and we're super excited about all our themes. So one of our themes is women-oriented consumption. Women control 60 to 80% of all consumption decisions in the country, making them perhaps one of the largest markets in the country of over $1 trillion, right? Within this, there's a rise of femtech. We earlier this year invested in a very interesting femtech company called Gynoveda, which supplies Ayurvedic products to tackle the problem of PCOS. So women's health is a massive market. Staying on this PCOS, 1 in 5 women in India unfortunately have PCOS. That's how large the market is, right? One of our other investment themes is the confluence of financial services and technology. We have been the first private equity fund in the country to invest in CIBIL, India's largest credit bureau. If you look at the way applications for credit have moved over a decade against, let's say, take the decade before COVID, it moved from 1 million applications per month to 1 million applications per day. That's 30x growth in that period, right? And penetration is very low in several of these sorts of opportunities even now. Okay, healthcare is a very important segment for us. Within that, what we've seen over the last few years is a very interesting merging of health and wellness. We have a company called Brinton Pharmaceutical, which is a dermatology company in our portfolio, which over the last few years has pivoted from being a pure play pharmaceutical company on the RX basis to also coming out with curated wellness products. Today, their sunscreen is the #1 prescription sunscreen in the country. Okay, so going forward, what am I excited about? Very excited about consumer, but not just digital first, more of an omni-channel consumer story. We think that with the focus on pollution and all of that, there's going to be a lot of interesting opportunities in the circular economy. I know you and I talked briefly about this before. We think SaaS has always been very interesting. We think the multiples peaked in 21. They've come down. They've come down now. We are looking at one opportunity right now in the SaaS space. Health tech is an area that we think is going to be very exciting and very disruptive against the backdrop of some of the thematics I talked about.
Wonderful.
So, yeah.
Oh, that's quite a few segments, and happy that India is going the way it's going. So Himanshu, so all of these investments that come into the country, do you notice any trends around structuring in case of investors who want to come in, and startups that you're seeing more often?
Yeah, so I think typically, as Samir had mentioned, a significant amount of foreign capital coming into India. Earlier, anybody that used to talk of foreign investment assumed it is Mauritius, India, right? Or maybe Singapore to some extent. While that's still a significant portion comes from there, but there are people who are now starting to look at alternate jurisdictions and saying that I don't need that any longer because, again, the tax rules have changed. Earlier, there used to be an advantage of investing through Mauritius, Singapore, which has kind of been taken away now. So more and more funds are looking at saying that let me just come directly from the US or maybe from Cayman or whatever. So that is one change that is happening. The other structure that is kind of becoming more and more popular is this IFSC jurisdiction that is coming up and becoming more popular because it's kind of an hybrid as a foreign jurisdiction and an Indian jurisdiction. For FEMA purposes, it is treated as a foreign jurisdiction. So for foreign investors, there are some liberal rules that apply there, and it's a dollar fund. But at the same time, Indian fund managers can manage that fund. So typically what used to happen is that many of the Indian GPs sitting here used to raise foreign funds, but they could not manage that fund. They could only be advisors. They needed to have somebody manage that fund overseas. Now with this hybrid structure, they can actually use that. So that is becoming more popular and giving a lot of flexibility. Plus it also gives a good tax answer also, which is a matter of detailing. But that is one structure that is picking up quite a bit. Apart from that, I think generally the way the transaction structuring is done, I think that has not changed significantly over a period of time. I think because the way the rules are in India, I think more or less it still allows you to do the same kind of structures, nothing very different. LLP compared to company, I think that kind of a discussion typically happens, but from a listing perspective, I think people still continue to invest in companies. Credit versus equity, I think, is a discussion that happens. But when I think there are two different segments, sometimes a compulsorily convertible debenture has been used as a structuring option, and it came into play again because of an angel tax discussion that is picked up.
You have a question on that. That's coming.
Okay, we'll cover that in more detail then. But otherwise, I think from a structure perspective, I think this is the broad framework that the direction that we are moving in. And of course, the overall structure of foreign money being pooled into the Indian funds, the Indian AIF. I think that is becoming more and more popular. Earlier, there used to be a little bit of an hesitation for foreign investors to come into the India structures. But I think over a period of time, I think that has become more and more comfortable. So I think there is a lot of foreign money coming into the Indian AIFs and then being invested into India because that has its own advantages. So I think that's another structure that's picked up.
Excellent. So going into the investment process, right? So Vishal, in your opinion, right, do skewed valuations, which is a reality, and large amounts of capital impact the building, scaling, and listing abilities of a business? Is there a case where you have, I mean, let me put you on the spotlight. Is there a case where you have done it and you felt, oh, I gave too much valuation?
Yeah, so
We can take it offline also, but I'm interested in that.
I'm happy to answer, yeah. So let's go through what happens when an overexcited and myopic investor gives a company large amounts of capital at very high valuations. And we know that's happened a lot in 2021. We all experienced it. So two things happen. One is, as an entrepreneur, you get more capital than your company can absorb. That's one. And secondly, it alters behavior completely because now you have explicitly or implicitly promised to deliver certain growth and value, which your company may or may not be able to deliver, right? So then what happens is that you start buying growth. Instead of building, you start buying growth. And after 2 or 3 years, you realize that, you know what, I cannot deliver that growth. My numbers are not as great. And the valuation that I delivered, valuation that I raised money at was very high. Now, the same investor is now not excited anymore. That investor will not follow up and give you money at that same valuation or a higher valuation. Then, as an entrepreneur, you're left high and dry because nobody else is going to match the valuation that you raised at 2 years ago. And that's happened so often. So I meet companies, and you know, there's a rule of thumb in my company that if a certain fund, and I will not name that fund, if a certain fund has offered a multiple of X, we will start talking to that company if the multiple is half of that. And that is my starting position.
I'm assuming that none of us.
No,
Yeah, okay.
present company excluded. Absolutely, right? So what's happened is a lot of these entrepreneurs face very bad, they face very bad options. One is do a down round, which nobody wants to do, and because they have to do, not raise money at all and wrap up operations, or just limp along, right? So what I would recommend is that, and the markets are not confident, right? So when you go to the market, when they see these investors on the cap table and when they see these choppiness in your financial statements in the last 3 years, they are not confident at all. So it affects your exit, your listing, and everything to do with it, right? Now, your second question about so I have undervalued a lot of companies. But do I regret it? No, right? Because at that time, with that information, we've taken a call and I'll stick to it. And I'll tell you something, for every multi-bagger that I've let go because of valuation, I have avoided about 9 duds. So hence, I would never
Can I
regret.
tell them the name? I know the name.
Cannot take names, but yes.
I know the name.
You know the name, of course. So hence, would not regret those decisions at all. You know, that's
Wonderful.
That's us.
So, Himanshu, talking about valuations, right? We keep hearing in our ecosystem, angel tax is going to come, angel tax is going to come. So, is the tiger actually coming?
So angel tax is here. So angel tax is, again, just to give a perspective, angel tax is where if a company issues shares at more than fair value, the company is deemed to have received a gift. And it got the nomenclature of angel tax because typically angel investors used to give money at a valuation which was not linked to the actual performance based on future kind of an outlook. So it got that nomenclature. It kind of was under the radar, or it was there but not so high because first of all, it applied only to domestic investors, and within that AIFs were exempted. So it applied only to a certain set of investors who are Indian non-AIF kind of investors. Why it came into prominence significantly is because, again, this factor that India gets a lot of FDI, and this was made applicable to FDI from April 1 of this year. So angel tax is now applicable to foreign investors. And that's why it suddenly came into so much of discussion saying that it will impact transactions. And for foreign investors, it becomes even more difficult because they also have to comply with foreign investment valuation rules and then tax valuation rules, which kind of constrains them on both sides. So it gives very little leeway on transaction structuring. So that has become an issue. A lot of representations have been made to the government. They have come out with some series of clarifications trying to dilute the impact of this angel tax. is still not completely done away with, unfortunately. So one has to still think about it. But they have come out with some reasonable amount of flexibility with how to value a company. One thing they have come out with is to say that there are multiple valuation rules that you can choose from and say that I have complied with valuation and angel tax should not apply. The other good thing they have come out with is to say that again, if you are investing along with a domestic fund and if the domestic AIF has done a valuation, that is a benchmark. So then we will not question you. They have come out with some guidelines on trying to say that we will not assess you only based on the valuation of angel tax. If you have other issues, we will look at that. So there are some guidelines that have come out to try and dilute this, but it is an important issue for all structures today, especially for foreign investors, which they need to consider.
Lovely. Samir, now your chance to talk about bad apples, right? So, bad apples that we have seen in the VC or the early space, how do you approach, see, it becomes very critical, risk management and due diligence become very critical, right? You can't stay off it, you can't stay in it. So, it's like kind of a quandary that all of us are in, at least I'm in. So, how do you say this, how do you look at this space evolving, risk management and due diligence for early stage VCs?
Yeah, no, I think it's a good question.
It's a session by itself, isn't it?
Yeah, no, it's a good question. I think the way we think about it is that we want to have as much of a standardized process across the spectrum as feasible. And I say as feasible because clearly an early stage company has different characteristics from a growth stage company, from a more mature pre-IPO company. But we've tried to standardize both the deal evaluation due diligence process as well as the investment committee oversight process. I think one of the things that we have done over the years, but particularly this year, I think learning from some of the experiences in the broader Indian market over the last few years is really take the time up front. And as much as possible, that term sheet that goes in needs to be a high conviction term sheet with as much diligence as possible front loaded. It's not always possible, particularly in competitive situations or auctions or, you know, I guess the more competitive niches. But wherever you can and have some proprietary angle or some I guess, access, I think that's what we've tried to do. And I think, look, there have been some startup issues. I'm sure Shivani and Vishal will also touch on this. I think it's impossible to catch everything. So you just have to build the right process, trust that process, make sure that the investment team is driving the commercial diligence, and then you've got all the right stakeholders and consultants supporting you in the confirmatory diligence part.
Wonderful. So, is it still buyer beware or investor beware scenario? I mean, any of you can take it. So, are we still on the tenterhooks looking at whether we should invest in a business or not? So,
Say that again,
considering
Vignesh.
the issues that we are seeing nowadays, so are you very extra cautious when you sort of
Okay.
go into a deal, or you still have the same mindset?
I'll take that in the context of just. Okay, are we being extra cautious? I think if you look at what's happened in the last few years, right, and I'll echo some of what Vishal said earlier, where you had a myopic investor meeting a, teenage entrepreneur and flushing him or her with lots of cash, then that's a recipe for disaster, right? And I think the biggest takeaway over the last few years, to echo what Samir said, is that there's been a complete disregard for process. So are we being extra cautious? I don't think so. Okay. I'm actually very happy that the entire ecosystem is talking about process, is talking about unit economics, because we were struggling at the time when we would talk about process and nobody else did. And people would turn around and say, what? It's going to take you that much time to, analyze this investment. My goodness. And, we felt very slow and methodical or something like that. But the great thing is that everyone is talking. The entire ecosystem is talking about process. The entire ecosystem is looking at things, with the lens. And I think you can't be too cautious. I mean, Vishal and me avoided a massive blow up simply because of process and due diligence. So Vishal, please add.
Yeah, so the thing is, Vignesh, we are not extra cautious, we are the same. It's just that the public's perception
Of us has changed.
of us is different because in bullish times, when you have people writing you checks, with two questions asked, we seem extra cautious, but during these times, we seem relevant.
Excellent.
So that's the difference, I would say. Yeah.
Excellent. So we have to wrap up. We have exactly a minute. So one question, because since we have fund managers, what advice do any of you have for both new and emerging fund managers or investors looking to enter in the India private market space?
Sure, I'll take that. I think what I would say and what we've heard on this panel is India has tremendous potential in the venture capital and private equity market. Having said that, there's also now some established funds. There are certain market segments that are more crowded, more competitive. So I think my advice to new fund managers would be to make sure that there is an attractive niche from a supply-demand equation, that they're not just going after the most crowded segments where too much capital is chasing too few deals, and just make sure that there is a compelling competitive edge, right, in terms of the fit, the fund market fit, if you would, right, because I think at the end of the day, that's really sustainable.
Excellent. Any other comments?
Don't shortchange process.
Wonderful.
Do your due diligence.
For new fund managers, don't be the 100th fund on the street. Focus on differentiation. Focus on investing in creating your own niche, your own knowledge, and your own process. Because in the way India is evolving, I think showing up with just capital is not going to give you consistent returns. You may get lucky sometimes, but year in, year out, you will not make consistent returns if you don't have a differentiated strategy. That's my suggestion.
Wonderful. I think that's time. Time's up. Yes. So thanks. It was a great ending for me. I'm sure it was the audience. Thank you.